Good day, fellow investors. We continue with our stock analysis marathon, and with Verizon, we have a typical interest rate issue. We have analyzed Verizon when Warren Buffett owned it, and then also when he sold it, and it was always a dividend stock for me, and not much has changed. The stock still pays a dividend. So we have now what was usually 4.5%, now is a 6.67% dividend, and over the last few months especially, the stock has significantly crashed. What was the game changer here? Well, interest rates have started to change significantly, which impacts everything when it comes to Verizon. If you look at the cash flow summary, well, nothing that bad. Cash flows still very good. 3 billion, capital expenditures higher on inflation and expected. At these small changes already changed the free cash flows down by 25%, and the stock is also down. But they still have enough room to keep the dividend there, despite the fact that they have huge amounts of debt. And with that, if interest rates go higher, then you have an itsy bitsy issue because of higher costs. The guidance is, let's say, approximately flat, a little bit down. If we have a recession, of course, it's going to be a little bit down, but the earnings per share are still there. If they can keep the dividend, all well there. Big capital expenditures for 5G and everything. And that is the situation now. It all changes with the interest rates. Higher interest rates, a little bit of macro headwinds, and then Verizon slips as it expects. Also, wireless subscribers decline, but these are lesser factors. The key factors are the impact on the dividend, and not that much the change in the dividend, because Verizon increased its dividend recently. Now the forward yield is 6.32, 6.7 as the stock goes down. So the dividend for the dividend investors is still there. But what does Morgan Stanley say? Notes a lack of catalyst. So what will push the stock higher? Nothing. So let's sell, or let's put it into the negative basket, and that's it. Because everyone wants to buy stocks that will go constantly up. And if I look at what they say, of course, lack of near-term catalysts, and then if we dig deeper into the analysis, we see that at the end, what matters is the ability of the company to leverage these assets into sustainable operational and financial performance. That will definitely take a year more, 5 years, such as the fixed assets and the 5G network. And then they hope that the company has already reflected a sufficiently conservative view on inflation, interest rates, promotional and other pressures in their guidance. If not, it can go even lower, but still it's very interesting. 10% free cash flow yield make buybacks increasingly attractive compared to paying down debt, which was the focus. So it does not look like the company will buy back stock for at least a couple more years because of the huge 5G investments. But perhaps the most important thing that changed is this one. When interest rates were around zero, around 1.5, the 5% Verizon dividend looked extremely attractive. Now you can lend money to the US government at 4%, and then you say, okay, 4% riskless asset, so you're going to get your dollars and your coupon because no matter what, the Fed can print. On the other hand, you have a business like Verizon that has debt, that has competition, that has everything, and therefore you say, okay, I want more from Verizon, and that is the game changer here. So hiking rates, expected higher rates will impact Verizon from a debt perspective, from a cost perspective, from an economy macro perspective. So a lot of headwinds. But then again, the stock has gone lower and lower. There is the debt issue that always weighs on Verizon. So It is very interesting, but as the stock goes lower, it is an essential business that keeps everything and keeps you watching now over your online connection. This is getting very, very interesting. In that line, when I look at our portfolio, we're looking for long-term investments. There is the risk with Verizon, but I like the dividend and it fits our YouTube following portfolio, and we have been analyzing also in the past. So it is a strong contender for the YouTube portfolio, and I'll put it alongside HPQ and Disney for now on the contender list. And more about that then in a week or two when I have 7 to 10 contenders. We'll do Europe also, compare the valuations there too, and then see which ones are the best opportunities to follow over the very long term. This YouTube portfolio is a 10-year and longer project, so we must be very careful in the selection there. Thanks for watching. I'll see you in the next video.